Good afternoon, everyone. I'm Saisha, and on behalf of Kirin Advisors, it's a pleasure to welcome you all to the Investor Conclave, Investor Connect Summit 2026, powered by Avinash Mentor and co-powered by Kirin Advisors. Today marks a second day of our two-day summit, featuring a powerful lineup of focus management meetings. I welcome you all to the interaction with the Unihealth Hospitals Limited. From the management side, we have with us Dr. Akshay Parmar as founder and managing director. Hello, sir.
Good afternoon.
From Avinash Mentor team, we have with us Mr. Avinash Gorakshar. Hello, sir.
Yeah, good evening.
With that, now I hand over the floor to Avinash, sir. Over to you, sir.
Yeah, I think welcome everybody to the virtual investor conclave. We have with us today Akshay ji, from Unihealth Hospitals Limited. Although all of you know the background of the company, just to tell you, Unihealth has been a very large player in the African market. Now in the Indian market also, they have set up hospitals. And I think their focus has been very clear, right, on the profitability curve, which we have been seeing in their numbers. So without wasting time, Akshay ji, I'll request you to give a small background of the company and then we can start the Q&A.
Thank you, Avinash. Thank you for the introduction. Good evening, everyone. Unihealth Hospitals was incorporated about 16 years back in 2010. The company, as the first major vertical back then, was medical value travel or medical tourism, as it's commonly called. That was the major vertical for the company from 2010 to 2015. In 2015, 2016, the company started making investments into Africa to set up its own network of medical centers initially, graduated from there within a space of 2 quarters to set up its first hospital. 2017 to 2018. Between those 2 years, the company expanded its presence to have a 200 bed capacity between Uganda and Nigeria. In 2019-20, the company forayed into healthcare consultancy services, creating a consultancy vertical as a standalone business unit. Under that particular vertical, between then and now, the company has provided services and is actively providing services to a consolidated bed strength that exceeds 1,300 beds in projects across India, Middle East, and Africa. 2020, when COVID came in, that is the time that the company explored the opportunity of exports and distribution of medical consumable products and pharmaceuticals. And that is how the company ventured into that particular field. So between 2010 and 2020, the company forayed from medical value travel into medical centers, hospitals, healthcare consultancy, and pharmaceutical exports and distribution. These four major verticals of the company have been significantly interlinked, supporting each other and ensuring that either the profit margins for one vertical are improvised because of the presence of the other vertical, or one vertical is providing significant opportunities for the other vertical to grow. 2023 September, the company got listed on NSE Emerge. At that point in time, the company decided that its 5-year vision at that till calendar year in 2028 would be to expand its bed capacity and have a 1,000 bed plus commission bed strength. The company also decided to make a foray into the Indian healthcare space, and that is where the golden triangle of Maharashtra came into picture for the company. We decided to expand between Mumbai, Nasik, and Pune in the first phase of our expansion. The idea is to have a 500 to 600 bed capacity between these three cities in Maharashtra and simultaneously increase our bed capacity in Africa and have a 400 to 500 bed capacity in Africa, combining this to a 1,000 bed capacity by 2028 calendar year end. Right now, as we speak, the company has got 400 beds that have been commissioned, and there are certain additions that are being worked upon by the management. Hopefully, in the coming few quarters, the company will be moving fast at a faster pace to expand its bed capacity and achieve its initial target of 1,000 beds by the end of calendar year 2028. From that perspective, I'll just take a pause out here, and then we can move on to the Q&A session and take things forward from there. Thank you.
Participants, now floor is open for Q&A. You can raise your hand or you can drop your questions in the chat box. Yes, Nikhil, sir, please go ahead.
Hello, am I audible?
Yes.
Yes, Nikhilji.
Yeah. Hello, doctor. So my first question is how many beds we have in each and every hospitals? I'm a little bit confused about how many hospitals and how much bed capacity do we have in Tanzania, particularly.
Right, right. So as we speak right now, we've got two facilities in Uganda. One is our multi-specialty tertiary care facility in the city of Kampala, which is a 120-bed facility. We recently, in February 2026, added another 30-bed facility in a city called Entebbe. That is where the only international airport of that country is. So, combined, put together, in Uganda as a country, we've got 150 beds. We commissioned a facility in Navi Mumbai earlier. That is a 50-bed facility. We are in the process of commissioning our 200-bed facility in Nasik. Put together, we've got 400 beds between these three facilities right now. And we got certain facilities that are under discussion in India and in Africa, which we hope to conclude by the end of this calendar year.
Okay, so Dar es Salaam 100 bed capacity commercialized in FY 27, and along with
Yes, the target is to put it across and commission it in 26, 27. So it's a functioning facility. We are in discussions to acquire the operations of that facility. The discussion, there's a lot of statutory work that is happening in the background. So once we have completed all of that, then we will have a conclusive idea on the exact timeline, whether it is by the end of the first half of the year, it's in Q3, or it goes into Q4. But yes, that is something that is under discussion right now. Similarly, there are certain projects in India that are under discussion. The next step for us in India would be the city of Pune. So we are actively looking and pursuing certain discussions in Pune right now. So that addition, depending upon when we are able to conclude the discussions and complete the legal formalities to take it up, it'll be dependent on that whether we take it into our fold within this financial year or it goes into early next financial year. Nikhilji, are you there?
Hello. Am I audible now?
Yes.
So in Tanzania, we have only 20 bed capacity, right? That is the
20-bed
dialysis
facility, yes. So that's it was an earlier dialysis unit. So we are now upgrading it to a secondary care facility. So from that perspective, the work on ground is complete. We are just waiting for the statutory approval to commission that project.
Got it. And we also have a consultancy vertical in which you mentioned in your last call on 24th of June that you have a
Right.
small team of around 10 to 15 people. Who are these people? Are these architectural designers, interior designers,
So
engineers?
yes, so it's a mix. We've got a lead architect, so we've got architects, we've got interior designers, we've got project managers, we've got procurement and supply management people, and then we've got certain consultants who we take into consideration. So they're not a permanent feature with the company, but they are taken into consideration as and when the project requires it. So whether it's from the MEP side or whether it's from the medical systems, that's the medical gas pipelines and a wide variety of other medical systems. So we've got that network of consultants which comes into play as and when the project requires it.
Got it. And so one last question before I fall back in the queue. That do we also provide the pharmacy and the F&B services in our hospitals, or we do own the in-house diagnostics, or we have outsourced to the diagnostic part to another company?
No, the diagnostics, pharmacy, everything is in-house. There's nothing that is outsourced. F&B definitely is outsourced because that is not our core. And there's significant importance on the quality that we have. So it is better that we outsource it to someone who specializes in it. But yes, our facilities are all tertiary care at Par and Apollo or a Max or a Medanta. So from that perspective, end-to-end services are provided to every patient relative who's at the facility. So F&B is an important part of that. So we've got in terms of the medical and clinical side, we've got full-time nutritionists on board who decide on what kind of F&B is suitable and optimum for the patient. But the services have been outsourced. Diagnostics, radiology, pharmacy, nothing of that has been outsourced. Everything is within the company itself.
Got it. So can you just share me the revenue mix of between this pharmacy, the hospital services, and the diagnostics part for FY 25 and FY 26, if you have it?
So FY 25-26 from an Indian perspective, we haven't really delved deep into it right now because the facility in Navi Mumbai was recently commissioned. It is fairly new. But yes, for a facility in Africa, pharmacy would constitute about 25 to 30% of the total sales. Diagnostics would constitute, I think, about 15 odd percent of the total sales. And the rest of the sales would be between the inpatient services, between the surgical or the theater services, ICU services, and a wide variety of other services that are extended.
Got it. Thank you so much, doctor. I will fall back
Thank
in
you.
the.
Yes, Shubham sir, please go ahead.
Hi, doctor. Doctor,
Hi,
I have a
Shubham.
couple of questions. So I basically had listened to your con call post Q4 FY26, and I think you said that 250 to 300 CR is the top line that we are targeting for FY27, and obviously the PAT margins would be around 8 to 10%. So even if I go by these assumptions, sir, is it safe to assume that FY27 at an absolute PAT level would somehow be either similar or slightly lesser than FY26 because of the depreciation and the new centers utilization will take some time to kick in?
Right. So Shubhamji, I mean, in that particular con call that you made a mention, there was some discussion that we had on the numbers. So I had given I had provided some calculations on, what the top line is likely to be. In terms of the PAT, that is the conservative side that I had presented because there's going to be significant amount of depreciation that comes into picture as we expand. There's some cost of capital or the cost of finance which is going to come into picture as we expand, and OPEX is also going to be there. But I do not foresee any dip from the existing numbers. The idea for the company has always been to ensure that there's a healthy mix of mature facilities and new facilities at any given point in time. So quarter to quarter, it becomes a little difficult, but on an annual basis, I do not foresee any dip at the PAT level because of facilities which are already functioning. For example, Uganda, that's a mature facility where we are adding on various specialties and super specialties to ensure that the revenue base increases and the percentage EBITDA margin and the percentage PAT margin also increases a little so that it can offset whatever OPEX or depreciation related dips that we are likely to have in our new facilities. During the course of this year, we expect our Navi Mumbai facility to break even and to start turning EBITDA positive. So there will not be much of a burn at the Navi Mumbai facility. Nasik will be something that will get added on. So the burn at Nasik is going to get offset by the gains that we are likely to make in the other facilities, such that on an overall basis, the growth may not be the same that we witnessed in the previous 2 or 3 years in terms of the percentage point, but the absolute number is unlikely that it will undergo a dip. We do expect it to increase. The increase might be smaller than the previous years in terms of the percentage margin. I mean, percentage point increase on a year-on-year basis.
No, no, fair point. I think, Doctor, I think you all understand that because you are going live with new capacity. So obviously depreciation will kick in and it will take some time for the utilization to ramp up. So while I'm assuming the EBITDA margins would stay the same, Doctor, or EBITDA margins also might take a hit.
So right now,
Because
EBITDA margins are somewhere around that early 40%, the 41, 42%. With the OPEX coming in the newer facilities, the EBITDA margins are likely to come down, but the overall pie is likely to increase. So the absolute numbers might increase, but the EBITDA margins are likely to come down somewhere into the mid 30s is my expectation. So the EBITDA margins will come down for the at least, as we expand and as we add on new facilities every half year. That is a possibility that the EBITDA margins might come down. We do not foresee on a consolidated basis the EBITDA margins to go anywhere below the early 30s. So, in the process of our expansion over the next 2 to 3 years that we've earmarked, I do not see the EBITDA margins to go below the early to mid 30 level on a consolidated basis. But yes, it will come down from the early 40s that we are in right now, purely because of the OPEX that is likely to come in from the new facilities.
got it, got it. Doctor, another question is that recently, I think you have, posted one of the notifications on NSE BSE that we are planning to increase our stake in the Uganda facility, right? So I just wanted to
Right.
understand, like, what will be the impact on the shareholders' earnings once this happens, and by when this will happen?
Right. So the entire transaction is presently under discussion. We are waiting for a lot of statutory work to be done in the background. Once the board approves, then it will be put to vote by the shareholders. So the entire process, I believe, will take anywhere between 6 to 8 weeks from now on. depending upon the date of the AGM and put all things put together. In terms of the earnings for the shareholder, the EPS is likely to increase because there's going to be an addition of some profit that was going towards a minority stake. So that negation will reduce. Now, to what quantum? That only, as we take the transaction forward and we are able to share details with all the stakeholders, I'll be in a position to comment on that. But yes, whatever addition happens in terms of the stake that we are looking at, in terms of the increase in the stake that we are looking at for the Ugandan business, that addition to the EPS is going to happen.
Understood. Understood. And doctor, whatever expansions currently which are there in pipeline, right, with respect to the Tanzania 100-bedded acquisition that you're planning to do, and then the Nasik one which is about to go live, and then the conversion of the dialysis center, right? Do we need to raise any additional funds? Will we be diluting again, or like the additional funds that we have would be able to suffice that? Like, what
So
is the
for
plan
the
there?
projects that you mentioned, right? So for the projects that
Yes.
you mentioned, there is a financial closure. So we will not be looking at raising fresh capital in terms of equity. Some amount of overdraft or cash credit limits or some amount of debt is likely to come in to ensure that the addition of the equipment that is needed or the initial working capital requirements are met with, and the company is not stressed for the cash flow. But in terms of an equity dilution, these projects will not require any fresh capital to be raised via an equity dilution. But definitely, since the company is in a rapid expansion mode, in case there are opportunities which require further capex at a shorter interval, at an interval which is not catered by the cash flow accruals that the company has, then the company is likely to think about it. But there's no discussion that we have internally right now in the immediate timeline that we are looking at.
Got it. Got it. Just last question, doctor. What is the operationally bad target that we have for FY27 and FY28?
By FY27 end, we are targeting to add, the Dar es Salaam and the Mwanza, that is Tanzania, 120 odd beds. We will be looking at maybe another 20 to 30 beds in Uganda, so 150 beds. We are actively pursuing certain discussions in Pune. Some of these are greenfield. They might take about a year to commission. Some of these are existing facilities. So depending upon what we are able to take forward, there may be an addition of another 100 beds to the Indian portfolio. So all put together, about 250 beds on the higher side is likely to be the addition by the end of the year, and about 150 beds on the lower side is likely to be the addition.
This year, you are saying, doctor? FY27?
Sorry?
You're
During
talking
this
about FY27?
26-27. By the end
Okay.
of FY27 is what I'm saying.
And by
So the
end of
existing bed
FY28?
capacity is likely to go from 400 that we have right now to somewhere between 550 to 650.
Got it, doctor. And next year, like FY27-28?
So FY27-28 and the first half of FY28. So those 18 months is when we are looking at achieving the 1,000-bed capacity, whether it's commissioned or the near commissioning. So whatever the gap remains, that's about 350 to 400 beds. That is something which will come into play in that 18-month period of FY27-28 and the H1 of FY28-29.
Got it. So in next 2.5 years, we are looking at 1,000-bed capacity. Is that the right way to look at it?
That's right. Yes.
Okay. Okay.
Yes.
Thank you.
Yes.
Thank you.
Yes.
Thanks a lot, doctor.
Thank you. Thank you.
Yes, Nikhil sir, please go ahead.
Hello, doctor.
Yes, Nikhilji.
Yeah. So, you mentioned as we are expanding into our foray into India, where there is so much lot of competition by the earlier big hospitals and PE-backed hospitals, and you've already rightly said that we are focusing with we are starting with small bedded hospital, low bedded hospitals because we don't want to compromise on care. But there's also another aspect of the competition, that is cost. Since UMC Mumbai have gained so much traction about this robotic new knee replacement surgery that you guys have done. Kudos on that. So my question is, what is the cost of knee replacement surgery in UMC, and what is the cost of a knee replacement surgery in other corporate hospitals in Navi Mumbai or
Right.
Mumbai MMRDA region?
Right. So I'll give you a knee replacement surgery at UMC Navi Mumbai will cost you. Now I'm talking about a single knee replacement, single side. So unilateral total knee replacement at UMC will cost somewhere between 2 lakh rupees to about say 3.5 lakh rupees, depending upon the category of the room that you are opting for, depending upon the implant. Though the implants are price cap, a small variation is likely to happen depending upon the small variation cost of purchase for the hospital. So from that perspective, anywhere between 2 to 3.5 lakh is the cost for a unilateral knee replacement at UMC Navi Mumbai. The same for a larger facility like an Apollo or a Medicare or a Fortis in Navi Mumbai. In my understanding, is likely to be somewhere between 2,75,000 to about say 4.5, 5 lakh. It may even go beyond because those hospitals then have got the uber luxury suites. So if you're opting for any of those, then the like cost is likely to go above 6 lakh also. But yes, on an apple to apple general ward, private category, and the junior suite or the suite category at Navi Mumbai UMC would be between 2 to 3.5 lakh rupees. Comparative at a larger hospital is likely to be somewhere around 2.75 or 3 lakh to 5 lakh rupee.
Got it. And so, as we said that we are a tertiary care multi-specialty hospital, but if someone wants to go to UMC for any specific surgery or a part of treatment, what specialty do we cater to?
All specialties, Nikhil ji. So in Navi Mumbai, the only missing thing that we have right now, or a couple of missing things that we have right now, we do not have mother and child care. So we are not doing maternity. We are not doing the neonatal ICU. So the newly born children who need intensive care or management, we are not able to provide that. And we do not have, radiation care. So we are able to provide cancer surgeries and chemotherapy, but we cannot provide radiation therapy or radiation care. And the last thing that we cannot provide is organ transplant. Other than that, anything, whether
Got
it's
it.
spine surgery, neurosurgery, laparoscopic procedures, gynecological procedures, orthopedic, joint replacements, all those cardiac bypass or angiographies and angioplasties, all of that is being catered to at UMC Navi Mumbai.
And do we have this basic services like dental, ophthalmic? Uh,
Ophthalmology and is something that is under discussion right now because of space constraints. Right now, we do not have. So, dental definitely we do not have right now. Ophthalmology on a call basis, depending upon the requirement, we are able to cater to the requirements of the patients that are coming in, majorly towards the admitted patient category. When there's a patient in the ICU or where there's a patient post surgery and an ophthal evaluation is needed because of diabetes or something like that, we've got the doctors empaneled with us who come, provide their consultation services, provide the basic diagnostics that are required at that point of time. But yes, comprehensive ophthalmology and dental are also services that right now are not there at UMC Navi Mumbai. Albeit all these services, except radiation care and organ transplant, will be there at UMC Nasik. So radiation care will not be there at UMC Nasik, at least not in the first phase. And organ transplant is something for which the infrastructure is ready, but it is a licensing process, and that is likely to take at least 18 to 24 months after the commissioning happens. So from that perspective, these are the two services that are not likely to be there at UMC Nasik right now. But Navi Mumbai, there is discussion ongoing for dental and ophthal. As we speak, ophthal on inpatient basis, we are catering to. Dental, we are not.
Thank you, sir. So my next question is, how much how many what percentage of doctors are on visiting and permanent basis, and if the permanent doctors are they on any minimum guarantee model, or what model are they being paid upon?
Right. So, in all at Navi Mumbai, we've got more than 125 to 130 doctors who are empaneled with us. Of this, majorly they are on a visiting basis, but definitely the key specialties that we have, which is general medicine, general surgery, orthopedics, spine, chest medicine, intensive care. So these are and cardiology. So these are the seven key specialties which are able to, which we've got on either a full time or a minimum guarantee basis, so that round the clock care within these faculties is available. And when we talk about these faculties, all put together can take care of any emergency case that comes in. So whether it's a trauma, whether it's a road accident, whether it's a fall, whether it's a heart attack, or whether it's say any other injury, all of that put together between these specialties we're able to cater to. So these are the specialties that we have aligned with us as either full-timers or doctors on minimum guarantee who we are sure of will be available round the clock at UMC. And all the other So super specialties are on a visiting basis, on a consultant model. Even within these specialties, other than the doctors that we have associated with us as full-timers, we also have doctors who are empaneled, who are coming in, providing their services both on OPD and inpatient basis, and providing their surgical care as well. So all put together, about 125 to 130 doctors are empaneled at the hospital. About 8 or 9 doctors are there who are associated with us with some sort of a minimum guarantee or professional fee structure, which allows us to consider them as either full timers or dedicated to UMC in a large format.
Thank you, sir. That's it from my side. I'll follow
Thank
back on the queue. Thank you.
thank you.
Thank you, doctor.
So we have few questions in the chat box. You mentioned that you have two hospitals in Uganda, Kampala and Entebbe, and another two in India, Nashik, 150 bed, and Navi Mumbai, 50 bed. However, your website also shows one hospital in Kano, Nigeria, and one medical center in Tanzania. Please clarify.
Right. So two clarifications out here. Nasik is a 200 bed, not a 150 bed. And medical center in Tanzania is something that was a dialysis center earlier. Since we were upgrading, the services have been stopped. We've upgraded it to a 20-bed facility with mother and child care, with dialysis, with basic surgical care as well. Licensing is ongoing. So once we recommission, that particular center will be operational. But I do agree, I will have the team recheck on this, on whether a notification related to this on the website has been mentioned or no. Kano, we had a 80-bed hospital which was there, which was, we moved out of that facility about a year back. So in case there's any mention of that on the website, post this call immediately, I'll update the team so that we are able to pull that out. Though to the best of my knowledge, majorly it was pulled out, and I've been discussing this in almost all con calls. But if there has been oversight in terms of its mention on the website, we will be removing it in the next 2 or 3 days for sure.
Hi Akshay sir, kindly give an idea about current
ARPOB in India and
AR
Uganda,
top.
also by what percentage it can increase in the next 2 years. So, Shobhit the current ARPOB for Uganda is somewhere in the early 40,000s. It's, I believe, about 42,000 and some, something above 42,000 for FY 25-26. For the Navi Mumbai facility, it's still very early in the, in its life cycle for us to actually be having some relevant ARPOB. Our expectation was to achieve 27,500 for the first 3-4 months that we were operating it, but I'm happy to share that we crossed 32,000 for that. So the ARPOB, as compared to the assumption and the anticipation, has been better in Navi Mumbai. The target for Uganda would be to inch towards 45,000 and cross that in the coming in this ongoing financial year. For Navi Mumbai, initially the thought process was that for FY 26-27 we were targeting about 32 and a half, 33,000, inching towards 35,000. But since we've already achieved a 32,000 plus RPOP, we've revised that target. We are looking keenly at 35 to 37,000 by the end of the financial year on an average basis. So that is the RPOP that we have. For Nasik, the initial target will again be somewhere between 27 and 27,500 for this particular financial year. And then going forward, the target for the Indian facilities would be somewhere around 40,000. 40 to 45,000, by the time they mature. So now what I'm sharing is is what we are looking at in achieving in the next 24 months from now on. These targets will keep getting revised as we inch towards the maturity level for these facilities. For Uganda, the next target would be to cross 50,000 in the same period. The next question is, I think Shauryaji who's mentioned, what is the occupancy rate? So for Uganda, the occupancy rate is just about 70%. So 65 to 70%, it moves behind that particular occupancy rate. For Navi Mumbai, again, it's extremely early, so it'll be difficult. The targeted occupancy rate for this particular financial year would be between 55 to 60%. Safe zone would be about 60-62% that we'll be looking at. Nasik, since it'll be fully operational only in a few weeks from now, I can only safely consider the H2 part of it. It requires some time to get traction. So maybe by the end of this financial year, Nasik, we may be targeting around a 40% occupancy. The next question is from Saurabh ji on the receivable days. So, because we've got a wide presence across different geographies, the payer mix is very different in each of those. So right now, the contribution to our top line is majorly coming in from a flagship in Uganda. So about 82% of the contribution to the top line comes from Uganda. And Uganda, the payer mix is slightly different. It does not have a national health insurance or something like the Pradhan Mantri Arogya Yojana that we have in India, or the national health insurance that is there in Tanzania or Kenya. So Uganda, the payer mix is about 20 to 22%, which is cash paying patients. Another 25 to 35% is between the corporates, the private insurance companies, the regional insurance companies, accounts that we have with the United Nations. And then it comes the 45 odd percent plus minus, which comes from a wide network of government departments or government backed, what do you call, PSU like units. And it is because of this particular reason that the receivables are significantly high, because there's a set pattern that these departments have, where the payments are staggered such that we receive payments in a timeline of about 9 to 12 months. And in view of that, the receivable days are significantly high. But over in our experience over the last 4, 5, 6 years that we've been catering to these departments and these units in Uganda, the payments do come in. They do come in without any rejection or deduction. It is only the timeline that is longer as compared to a private insurance company or any other corporate client that we have. Nikhil ji has mentioned, do we have any VIP passes or family plans to entice OPD patients? Yes, we've recently launched a VIP family card in Navi Mumbai, which offers a wide variety of benefits to the person who's holding the card, to the spouse, and to two children below 12. So that is something that we've had a soft launch about a week, 10 days back, and we will be in the process of marketing that significantly in the coming few months.
Yes, Ram sir, please go ahead.
There's a question in the chat box, if I can take that. Your historical PAT margins have been at least north of 20%. What is the reason for lower guided PAT margins going forward to 10%? So, like I mentioned, one reason is that it is a conservative estimate. Second is that since we are expanding rapidly, we will be commissioning and adding on a significant, number of bed capacity in the coming few quarters, whether it's Navi Mumbai right now, whether it's Nasik in the coming quarter, or whether it's any other additional facility in Pune or in Africa. Now, when we are adding these initially till the time these facilities break even, there's going to be a significant addition of the operational expenditure from these facilities. There's going to be added on depreciation. There's going to be some amount of cost of finance also coming in, because we will be looking at either working capital facilities or term loan for taking up the equipment that we need at these hospitals. So all these put together are likely to pressurize the margins to some extent. Now, whether it comes down to 10%, whether it's about 12% or 14%, that is something only time can tell. But yes, on a highly conservative side, it is going to be somewhere in the 10 to 12%. That is again an assumption that we have. That is again the intent that the management has. That is what we are looking at. Like I mentioned some time back, that our entire expansion strategy is based on the premise that we have certain facilities which are mature, which are improvising the top line and the margins, and they are buffering or offsetting a lot of OPEX that we are likely to incur in the newly commissioned facilities. So put together on a consolidated basis, the margins at the EBITDA and the PAT level are likely to come down a little bit from what they are right now. But on absolute number basis, the total pie itself is likely to grow significantly. So what the company has in terms of revenue, that revenue is likely to significantly grow in the coming few quarters to a coming couple of financial years. And despite a small dip in the margin, the EBITDA number and the PAT number in terms of absolute value are likely to witness some growth.
Yes, Ram sir,
The
please
next
go
is
ahead.
Nikhil ji.
Oh, okay, sir. Ram sir. Okay, sir, let's take the questions from the chat box.
Right. So Nikhil ji has the next question. What will be our marketing cost as a percentage of revenue going forward to gain market share? So for all the new facilities, initially the marketing cost is staggered in a two-way modality. There's a particular corpus that we align for the first 3 months because we are absolutely new. So that's like a one-time cost that we have to create brand awareness to market. That ranges upon the bed capacity that we have. But on for the first about say 12 to 18 months, I would say that we will be looking at spending about anywhere between 5 to 12.5% of the revenue. Why this range? Because the initial few months the revenue is going to be smaller, the marketing cost is going to be a higher percentage. While the marketing cost is likely to remain the same for the next 6 months, the revenue pie is going to increase. So from 12.5%, it's likely to come down to 10, maybe 7.5% as well. So that is the estimated marketing cost as a percentage of revenue that we are looking at going forward. In terms of the I optimization of the marketing costs, it is likely to happen only after the first 6 months that that we've commissioned our services. Next question is, I think, from Rahulji in the chat box. Receivables cash conversion. Has the 112 crore trade receivable balance started unwinding? What's the current DSO on the Uganda MOD sovereign book specifically versus the rest? OCF was negative through FY 26 despite rising PAT. So when does the cash conversion turn positive? So yes, there has been some amount of funds that have come in terms of the payments from the Ministry of Defense that keeps coming in every quarter. The idea at the Ugandan level has been, even from the intent from the government side, is to start reducing the receivable timeline from the present cycle of about 12 months to bring it down to somewhere around 9 months and eventually target a less than 180 day. It is likely to take about 4 to 6 quarters for it to actually be seen, because they are going to be doing it in a staggered manner. That is the intent that they have mentioned of. Though time will tell whether that actually goes into execution or not. But yes, of that outstanding receivable, there's considerable amount of payment that is being received. Simultaneously, we are providing our services. So the outstanding, it comes down and again goes back to by a certain level as the month ends. The operating cash flow was negative, but as in 2023 itself, when post our listing, when the management decided on the expansion strategy, one more decision was taken at that point of time that over a period of 3 to 5 years, we will be reducing our dependence on the consolidated top line from any one geography to less than one third. Barring India, India of course is a significantly different geography put together. But for all the overseas geography, where right now, for example, Uganda is contributing to 80% or more, the idea is to let Uganda grow, but simultaneously commission services and facilities in various other geographies, whether it's Tanzania or the facilities in India, such that on a consolidated basis, the dependence on the top line from Uganda comes down to about one third or less. And we are on track to achieve that. So hopefully by FY 27-28, it will be seen on the books as well. This particular financial year also, it is going to be a significant shift from what it was for FY 25-26. Since we will have Navi Mumbai contributing, we will have Nasik contributing, hopefully we will have Tanzania also contributing. So from that perspective, we are moving towards that. Now, how does it impact the operating cash flow is that other than Uganda, a lot of other countries that we are expanding in, whether it's Tanzania, which has a national health insurance scheme, the payment cycle out there is roughly around 90 to 100, 110 days. In India, obviously, some facilities where we do not have government scheme, the payment cycle is less than a month, because majorly we are targeting cash and insurance patients. For facilities like Nasik, where we are likely to have some government schemes, the average is likely to be somewhere around 60 odd days, or maybe 60 to 75 days. So from that perspective, on a consolidated basis, the receivable days are going to come down as we expand into different geographies. The operating cash flow is also going to be changing significantly. The next question from Mr. Ram is, how many months or years for a new facility to mature? What would be the break-even time? So in Africa, all the facilities that we have commissioned till now, the ideal scenario for us has been less than a year, and we have broken even in within a year for those facilities. India, obviously, with the amount of competition that is there, the pricing structure is different, so it's likely to be significantly more than that particular period. For us, for a facility which is a 50 bed like Navi Mumbai, The target is about 12 to 15 months. We are quite confident of achieving that. The target is to break even before the end of the first half of this particular financial year. When we go for Nasik, which is a slightly larger facility with 200 beds, we are looking at breaking even somewhere around the 18-month to 24-month period. So that will be the timeline for during which we expect to break even. In terms of maturity, usually a hospital starts maturing between 3 to 5 years. That is when the curve shifts significantly, where the revenue increases, but the margins increase more than the revenue increase because you're able to optimize a lot of costs. There's a significant amount of brand recollection that happens. There's a lot of patient flow that comes in, which is word of mouth marketing, or which is old patients coming in. So from that perspective, a 3 to 5 year is ideally the sweet spot in which we can start calling the facility mature. Post that, what super specializations we add, the entire growth in terms of top line and the profitability depends on that. Next is from Shobhitji. Any plan for oncology and neurology department foray in India and Uganda? Yes, and we presently also we have both these. So neurology, we are already providing neurology diagnostic, medical management and neurosurgical services at Navi Mumbai. We've got a neuro microscope also in place at our OT complex. We are fully equipped to cater to all the requirements that that department has, whether it's diagnostic or therapeutic. When it comes to oncology, we are providing services for oncosurgery and chemotherapy right now. Radiation care is something that is not there right now. We will be looking at it maybe in phase two of our expansion, where some of the existing facilities that we are commissioning right now may get added on as a super specialty. Radiation care makes a lot of financial sense once we've got a set base of patient clientele walking in, because the capex for a radiation therapy unit is significant, both in terms of the civil infrastructure as well as in terms of the equipment. So from that perspective, we would want some of our facilities to have those services where we can cater to the demand of the local patient base as well as our international foreign patient base which comes in, and we will be looking at it as phase two growth for the company. Any plan for giving quarterly results and also for migration to the main board? Yes, migration to the main board is something which we are definitely looking at and keenly waiting for the timeline of 3 years to get completed, which we complete in September 2026. That is when we become eligible for a migration. All the remaining eligibility criteria the company is already met with. So once the timeline is completed, we will initiate the process to migrate to the main board. Based on the understanding of how the market is in terms of the statutory requirements, I understand a 3 to 4 month period is likely before we can make a move to the main board after our application is submitted. So if all things fall in place by the end of the financial year, ongoing financial year, we should be on the main board. That is the intent of the board. And definitely implementation process, which is likely to happen in due course. But eligibility wise, it will be September 21, 2026, when the company completes 3 years of listing and we become eligible. Quarterly results, yes, that is also something which is going to become a compulsion as we migrate towards the main board. At present, the intent is there, today being the last day of the first quarter. Internally, we are working on it. We will have a discussion related to this at the board level very soon, and accordingly, we will be taking a call whether we are publishing the results for the first quarter and the second quarter, or we go for H1, and then once we are migrating based on the statutory norms, it will automatically become quarterly. Mr. Ram, so how many months or years for a new facility to mature? What would be the break-even time? And when will these facilities start to show similar margins to what is shown by older and established hospitals of yours? So the first of the question I've just answered, about 12 to 18 months for Navi Mumbai, 18 to 24 months is the break-even time that we're targeting for the facilities in Nasik. Similar margins, now that is a question that, these are two very different markets where we've got a presence. Africa works very differently, India works very differently. The cost structure is different, the supply demand gap is different. So while the target EBITDA margin for Africa is always the late 30s and maybe the early 40s, depending upon how we super specialize, in India, the target is going to be mid 30s. It is unlikely in India for any hospital group for that matter to cross the late 30s and early 40s mark. Because of the way the pricing structure is, because of the way the government scheme, charges are. So yes, as we mature between the 3 to 5 year period, we will be looking at a mid 30 level of EBITDA margin. but to inch towards a 40% or more EBITDA margin in the Indian market is unlikely. But the major difference between Africa and India is that the scale at which Indian facilities are likely to operate or can operate is significantly different. Out here, the potential to grow from 100 beds to 1,000 beds is there. Unlike in Africa, where each country is likely to have a ceiling depending upon how the healthcare structure and scenario in that particular country is. So we do not foresee having a bed capacity that exceeds 350, 400 beds on a consolidated basis in any African geography for that matter, because the population itself is, not supportive of a larger tertiary care bed capacity. But in India, the target can always be 1,000 beds, 2,000 beds, 5,000 beds, and even more. So the absolute pie in India is, significantly different than it is likely to be in Africa. Rahulji, minority consolidation, what consideration mechanism, cash, share swap, warrant, funds the Uganda minority buy-in post those are likely performer attributable. So, like it has been mentioned in post the last board meeting, we are looking at acquiring the stake in Uganda in a share swap modality. The definitive details of that are likely to be shared only in due course once the process at the statutory level completed and has been presented to the committees and the board for their discussion and approval. And in the same manner, based on what the structure of the deal is, the PAT and all the other details are likely to follow or are likely to be calculated. But yes, right now it's not a cash transaction. It is a share swap that we are looking at.
Yes, Shubham sir.
No, Doctor, I have a couple of questions. So one question is that what is the RPOB that we had in FY 26, 25, 26, and what we are targeting for FY 27 and also FY 28?
Right. So RPOB for FY 26 for Uganda was, I think, about 42,000 plus minus. The exact number I'm not able to recollect right now, but in that range. So maybe $200-300 more than 42,000. For Navi Mumbai, it was 32,500 for whatever small period that we had been fully operational. So we got our final set of licenses, which allowed us to take in critical care patients by mid-Feb. So technically for that particular financial year, we were fully operational only for about a month and a half. That is the period when we were able to do complex procedures. Prior to that, between October and mid-Feb, we were focusing on OPD basic surgeries, but not anything which was complicated in nature or which required a significant ICU backup. So the RPOP for the Navi Mumbai facility during that particular financial year was about 32,500. As we move into FY 26-27, the idea for Uganda would be to cross 45,000. The idea for Navi Mumbai would be to cross 35,000 in terms of RPOB and start bettering it from there on. Nasik is going to be a new facility. So Nasik, we will be looking at about 27,500 rupees for the ongoing financial year. For FY 27-28, Uganda, we will be targeting 50,000 because we are adding on a lot of super specialty. We are adding on ophthalmology. We've added on IVF a year back, which is getting a lot of traction. We've reinvented our orthopedic and spine department. We're likely to make further additions into neurology, neurosurgery, and maybe cardiology in terms of interventional cardiology as we move forward. So by FY 28, all these are likely to start generating revenue. The margin, since the overall the team strength, the overall management cost, everything is already been catered to by the existing revenue that is coming in. Whatever additions we make, the margins are going to be significantly higher compared to what we are enjoying right now for the other specialties at the hospital. So from that perspective, the margin is likely to improvise a little bit. The RPOB is likely to improvise a little bit. The target would be to cross 50,000 for that financial year. At that point of time, Navi Mumbai, we will be looking at early to mid 40,000s. So maybe 42.5 to 45,000 would be the ideal target. And for Nasik, which is a slightly larger facility where we are also likely to have government schemes and empanelment with those where the cost structure is a little lower, the RPOB that we will be targeting will be in the mid to late 30,000s.
Got it. And Doctor, let's say if I just talk about all the running facilities, including the Nasik one, whenever it will be operational, right? At 70% occupancy, which I am assuming is the maximum occupancy that we can have at any point of time, what is the maximum revenue that we can generate?
So I'll put it this way. For every 100 beds, if 70 beds are occupied throughout the year on an average basis, and each bed is generating about 35,000, which in my translation would be somewhere around 1.5 odd crores. So from that perspective, yes, about each 100 bed facility can generate somewhere around 105, 110 crore rupees of revenue. So that can be the revenue potential. The varying factors out here would be what specialties that you're catering to, where the focus is, because there are certain procedures. For example, I talk about cardiology. If we are focusing more on cardiology, there's a lot of diagnostic cardiology like angiography, then angioplasty is happening. The average stay of a patient is just about one night, 2 days, or maximum 3 days. So 2.5 days is the average length of stay that a patient has. And during that period, the revenue cycle is going to be somewhere between 1.25, 1.4 lakh to about 2.5 lakh rupees. So the RPOB increases significantly when the patient contribution from such specialties and super specialties increase. Vis-a-vis, you look at medical cases. If I've got a lot of patients with malaria and dengue during the July, August, September period because of the monsoons coming in, out there the patient is likely to be admitted for an average length of stay which is 3 to 4 days. And during those 4 days, the average billing of that patient, for his entire stay is likely to be just about 80,000, maybe a lakh rupees, not beyond that, because the treatment is more of observation and just very basic medication. So, from that perspective, it crossing that mark of about 1.5 crores will depend upon what kind of specialty and super specialty the focus is on, the patient flow is on. So on a thumb rule basis, on an average basis, if I'm to look at, for each 100 beds at an optimum occupancy of 70%, we are likely to target a consolidated revenue from that 100 bed to be somewhere around 105 crores. And then as we super specialize, or as we work upon certain specialties, it can go up by about 15 to 25% from that particular base.
Got it. So, doctor, this 1 to 1.5 CR is for 100 beds, or will it be applicable only for 70 beds which are operational? Like,
No, so
what
it
will...
will be applicable for the 70 beds. So it's, RPOB is basically average revenue per occupied bed. So I'm talking about 100 beds. If I've put in 100 beds under UMC, then occupancy rate on an average, like you mentioned, about 70% at a near maturity level. So 70 beds would be occupied. And this particular figure of 35,000 per day will be for those 70 beds. So that 1.5 crore would be for those 70 beds. And that is the metric that almost every hospital follows. So it's average revenue per occupied bed.
Sure, sure. Makes sense. And doctor, the second question is that I think one of the strengths of UniHealth is that we have a captive audience in patient base in Africa, right? And I think a lot of hospital chains, even corporate chains, are now trying to attract these international patients, obviously because for the reasons that the margins are high and these are all generally done in cash, right? So, what is our target there, and what is our strategy there to sort of double down on that? And do we have any? I mean, have we taken that into account while doing these projections, or that is an optionality that we are right now leaving on the table?
No, so the focus is there. There's a significant focus on that. We expect a significant turnaround to start happening maybe 3 to 6 months from now, because that is the normal timeline for any international patient base to start moving. Because once they are sure that they want to come to a facility, then a lot of them are likely to, gather funds or apply for their documentation, and then, wait for the right time for them to travel. So maybe in the next 3 to 6 months, we will start getting a decent flow of international patients. In terms of the projections right now, part of it has been taken into consideration, which is the bare minimum. If we're able to improvise upon that and structure the strategy internally in a manner where we're able to benefit from our presence in Africa and India in an optimum manner, then it is the cherry and the cream on the cake. So that will be an added advantage. The RPOB is likely to increase because of that. The margins are likely to increase. But right now, in whatever discussions we've had, whatever intent that the management has for the next 2 years that I've shared, we have not taken into consideration the cream and the cherry.
Got it. Got it. And doctor, just last question. As of now, is it true that we have 200 beds operational, like 120 plus 30 plus 50?
That's right. And Nasik, we are expecting in a few weeks from now on. So we've received the hospital registration. We are awaiting 2 or 3 more licenses that are required to ensure that we are fully functional. So hopefully in the next 3 to 6 weeks, that is the tentative timeline that we are looking at to be able to receive all the licenses and commission services. So yes, by the end of the first half of this financial year, we will have those 200 beds also added on, so that we will have a 400 bed capacity, which is fully commissioned.
And then in the second half, we will have 20, the dialysis center conversion, and another 100 one. That 120 is in pipeline.
Yes. So the 20 is a given fact because we already, I mean, that is a location that we already had. The facility is ready. The 100 bed is something where a lot of statutory workup is getting done locally in Tanzania. So once we're able to cross that bridge, then that is when we'll be able to sign the dotted line and take it forward. So yes, if that happens, if all goes as planned, that 120 bed will get added on in H2.
Got it. So you're saying 20 bed is something that will definitely happen. The 100 one depends on the statutory approvals and other
Yeah,
things.
certain statutory requirements that are there on ground, because that's a functional hospital. So there are certain additional requirements that are likely to come up when we are acquiring the operations of a significantly older functional unit, based on the local laws and the local requirements that are there in Tanzania.
Uh, and doctor, is there also a possibility, because I remember in one of the discussions that we had last year, like I attended one of the con calls and we were discussing the same point, and you said there is a possibility that this M&A can fall apart as well. So is that a
See,
possibility still or no?
yeah, so from the time that you're mentioning about say 6 months or a year back to now, we've covered a lot of ground. So a lot of discussions and deliberations internally between Unihealth and the other party have been completed. So we've agreed upon all the terms that were under discussion at the point in time. Now, what we are both awaiting is a conclusion in terms of the statutory requirements, statutory approvals, and the finer detailing of the legal language that the consultants are working upon on both the sides. So there's some aspect of legality, there's some aspect of taxation, some aspect of statutory approvals. So in principle, both the parties that are involved, that's Unihealth and the party on ground in Tanzania, the handshake has nearly about happened. But yes, it has to be taken forward after the legal, statutory, and tax related issues have been approved, sorted out based on the local requirements and laws.
But the only uncertainty is about the timeline. But the deal is going to happen.
The
Is that
deal
the
is
right way to
likely
think?
to happen. See, what happens is
Hmm.
when you talk about statutory requirements, I always leave that 0.1% gap out there because until and unless you've signed the dotted line and taken it forward and it comes under your fold, that 0.1% can also have some impact. So yes, in all
Hmm.
probability, we do expect it to be only a timeline issue, not really an issue today where the deal is likely to fall apart. But yes, still we do not sign it. I do not consider it.
No, fair point. Understood, doctor. And doctor,
Yeah.
what about the expansion across other geographies apart from Uganda, Tanzania? I mean, are we looking at other geographies? Maybe not
So we are
immediately,
studying,
but
we are
hmm.
actively studying a couple of other geographies which have, those have high potential, which are ideal in terms of the expansion that UniHealth is uh, likely to undertake in the near future. But the focus right now is to conclude the expansion that we're looking at in Tanzania. Once that is done, once it is off the ground, then we will immediately start looking at the third geography that is under consideration. So while consolidation will happen in Uganda, so that expansion and consolidation will continue to happen. Once Tanzania is complete, then we can move on to the next geography because it will not be worthwhile for us to lose focus on completing Tanzania and moving on to another geography. So there's already a team which is working, which is actively looking at the market potential, which is actively studying the dynamics of the third geography under consideration. But at the management level, we will take that step only once we have conclusively concluded the Tanzania bit.
Got it. And doctor, this currency depreciation is also
Sorry to
affecting us in a
interrupt,
way?
Shubham sir, but please limit your question to one or two due to time constraint. We will have to wrap this meeting at 6:30.
Sure.
Yes, Shobit sir, please go ahead.
Hello.
Yes, Shobhaji.
Hi, Akshay sir.
Hi, good evening.
Am I audible?
Yes.
Sir, thanks a lot for answering all the questions so patiently. Uh, I guess you need one or two strepsils because you have been speaking for more than 1 hour. So my question was, what could be the breakup of cash, insurance, and government business for Unihealth in India and Uganda?
Right. So in Uganda, like I've already mentioned, right now the mix is 20 to 22% in cash, about 30 to 35% in regional insurance companies, certain corporate clients, certain embassies, United Nations put together, and about 45% or so from the government departments. So whether it's the Ministry of Defense, whether it's certain other government PSUs. So that is the kind of payer mix that we have right now in Uganda. When we come to India, it will again be different for different hospitals. We are targeting a bed capacity of 50 bed to 200 bed in the Golden Triangle of Maharashtra, which is Mumbai, Pune, and Nasik. So if I look at Navi Mumbai, it's a 50-bed facility. It is in a location where we are not really looking at empaneling ourselves with a lot of government schemes because we do not have the bed capacity to cater to it. So out here, majorly the contribution is going to be from cash paying patients from insured segment where you've got TPAs and insurance companies and from a few corporates or PSUs that we are going to be empaneled with. So out here, the cash and insurance segment is likely to be about 75 to 80%, and 20% is going to be from corporate clientele or PSUs that we are aligned with and empaneled with. If I take this to Nasik, it's a bigger facility. The catchment area is such that a lot of patient base in Nasik comes from, tier three beyond Nasik, like Malegaon, Jalgaon, Dhulia, all of those places. The dependency on government schemes is larger out there in the catchment. So we will be empaneling ourselves with government schemes. So out there, again, the cash and insurance bit is likely to be somewhere around 50 to 55%. Nasik also has a significant industrial region. There are two MIDCs which fall under the Nasik and expanded Nasik area. So about 20-25% is likely to be from corporate and corporate clients, and 15 to 20% is likely to be from the government schemes. So that is the kind of mix that we are looking at in Nasik. Now, when we come to Pune, we are looking at two facilities eventually, one in the city of Pune, one in the PMRD or the Pimpri-Chinchwad Municipal Corporation region. So the Pune city, again, depending upon the location, we may not be looking at government schemes. We will be focusing more on the cash and the insurance part of business and some part of the corporates. When you come to PCMC region, depending upon the location that we are looking at, there might be significant contribution from corporate clientele because you've got Hinjewadi, which drains into PCMC. You've got the industrial belt of Talegaon and Chakan, which drain into PCMC. So from that perspective, again, corporate clientele, so credit clientele from that perspective, which ranges between 30 to 60 days, is likely to command about 25 to 30% of the business. About 50% it's likely to be from cash and insurance, and maybe about 20% from the government schemes. So PCMC might behave similarly to the Nasik facility, whereas the facility in the city of Pune, our focus would be to create that as a upmarket premium facility with a lot of focus on cash and insurance patient. So out there, the payer mix is going to be slightly different.
So we will take now last three questions which are in the text box.
So the first one is from Raulji. As you move cash from a high return Uganda into India, how are you thinking about the relative returns against the large established chains? Where do you see your structural edge? What lets a focused operator like you win in markets with the big players already occupy? So I'll take it step by step. As we move cash from the high return Uganda into India, both these markets are very different. There's a particular ceiling in Uganda. Though the returns are significantly high, I will not be able to go beyond a particular bed capacity when it comes to tertiary care. We can definitely expand our network of clinics. We can definitely look at expanding some amount of secondary care. But clinics and secondary care do not give you the same RPOB that a tertiary care gives. And tertiary care, there's going to be a limiting factor because of two reasons. One, the overall population of that country. Second, the kind of payer mix that we have. There's no real, public health insurance that is out there. So there's a limiting factor related to that. Compare that to, India. The payer mix changes significantly. The scalability changes significantly. So in India, if I'm to look at a 3 to 5 year period, we can easily target 1,000+ bed capacity within India itself. So from that perspective, though the margins are lower, the overall growth potential in India is significantly higher. So, plus there is no risk of any currency depreciation also coming in into the Indian operations since it's an Indian company based in India, working in India. So from that perspective, despite moving the focus or the cash investments from Uganda into India as we expand, one, it is a strategic requirement. It is a necessity for the next level of growth that the company is looking at. And third, definitely, the returns that we are anticipating and expecting once the Indian facilities mature are going to be comparable in INR basis with the returns that we are getting from Africa. So now this is something that we'll have to look at over a longer period of 5 to 10 years, because the shorter period may not be able to give us the right picture. Now, in terms of what sets us apart from, or how we are competing with the larger chains, so because we are a smaller facility, the focus for us is slightly different. The target audience, though, remains the same that a larger facility is looking at. The way we approach it is a little different, because the focus for us, being a smaller facility, we are able to provide a lot of flexibility and agility both to the doctors and the patients. So while the patients get the benefit of maybe the same kind of care, a more personalized touch to that at a lower cost, which becomes a pull factor for them. For the doctors, it's almost at par, getting the same sort of infrastructure that they are used to at an Apollo or a Fortis, in a smaller setup where the turnaround is very quick, where the patient, or rather their patients, are getting hand holding at every level. And there's some amount of flexibility in the commercial transaction also that they have. So from that perspective, we're creating a USP which can be unique to Unihealth, based on the size of each facility that we are looking at, based on the approach that we are looking at. The next one is there any option to increase the bed capacity in future, additional land parcel availability in our existing hospitals in India and overseas? Yes and no. So some of these facilities will have the ability to expand. There is some amount of resource available in the adjoining area that we can look at. And no, because some of the facilities we may not be able to expand further. We are looking at the optimum utilization of the infrastructure right now. So as we expand, as we look at about 7, 8, 9, 10 facilities in the coming few years, it is always going to be a mix. So when we start, one, we do not start in a very phased manner. So whether it was 50 beds in Navi Mumbai or 200 beds in Nasik, we go all out to start it together. Reason being that we do not want any patient walking in to be refused a particular level of care. So from that perspective, we start all out, and the market dynamics have already been studied. So when we entered Navi Mumbai, we saw a gap in the 50 to 75 bed capacity, and that is where our focus was. When we're looking at Nasik, the dynamics are a little different. It required a 150 to 200 bed capacity to be ideally positioned for us to make, for it to make financial sense out of it. So from that perspective, the first phase itself, whatever we are looking at in terms of bed capacity, there is limited requirement for a bed capacity addition that is likely to come up in the first 3 to 5 years. So from that perspective, some of these facilities we will be able to expand at in phase two, but the initial focus would be to add on a lot of super specialties within the same infrastructure that we have. Shobhit has put in one last question, which is are you planning to enter North India markets like Delhi, Punjab, UB? Phase one, no. Phase one, the idea is the first 500 to 600 beds between Mumbai, Pune, and Nasik and the neighboring areas. Phase two, yes, like I mentioned, once you achieve that critical level of 1,000 bed capacity between India and Africa, the next level of growth may be 2,000, maybe 5,000, maybe beyond that. And at that point of time, we will be looking at North and South as well. So Delhi, Punjab, UP are markets that we will like to study, understand more. There's significant competition out there, but the market size is increasing as well. So from that perspective, not for the next 2 years, but something beyond that might be interesting for us.
Thank you, sir. Thank you, sir. Thank you, all the participants, for joining this conclave. And if you have any further question, you can reach out to us at research@kirinadvisors.com. Thank you, sir. Thank you, everyone. Have a wonderful
Thank
day.
you.
Thank you, Akshay.
Pleasure. Thank you.